Hello, everyone. Hope you can hear me well, and thank you for joining. I see that more people are joining, but maybe we can kick off the session. So welcome to the launch of the report series on scaling insurance for climate resilience in Africa. These are developed by Crutham and commissioned by the African Climate Foundation. My name is Eva de Telinova, and I lead the African Climate Foundation program on adaptation and resilience investment platforms. And the objective of these platforms is to support African countries in developing, funding, and implementing a strategic response to climate change. And a core part of that is to act preemptively to reduce climate vulnerabilities, such as by taking adaptation and resilience measures. But as we all know, not all climate risks can be mitigated, and effective climate risk management requires using all the tools in the toolbox. So it is in this context that the question came about what the role of the insurance sector should be, and also what it has been so far. So we partnered with Crutham on these reports in order to learn what are the opportunities and also the challenges that the insurance sector faces. But we're also keen to engage insurance companies in the context of developing the adaptation and resilience investment platforms and understand better how we can facilitate a more strategic and better role for them. We're also keen to help government officials and policymakers in considering how insurance can support their response to climate change. So with this background, let me introduce Cecilia Schultz, I believe you can see on the screen, who is the lead author of the reports and who will provide a summary of the key takeaways. Just as a little summary of what you can expect in the next hour, I will invite Dr. Bo Matipibane from the Land Bank Insurance Company to provide his views and help unpack some of the key findings. And then we will open for a Q&A session. And my colleague, Wale Hammond, who is one of the reviewers of the reports, is going to help take some questions. So as we go through this session today, please do write in the chat box if any questions come up. We're going to start with those written questions, and then we'll also allow time for you to raise your hand. I very much hope this to be interactive and more of a conversation. So with this said, now let me welcome Cecilia, who is a senior researcher at Crutham. She holds a PhD in political studies, where she focused on the political economy of sovereign credit ratings in emerging markets. And prior to Crutham, she held a postdoctoral position with the South Africa-UK bilateral chair in political theory, which is hosted by the Wits University. And her focus there was on affordable housing finance, urban transformation, and the politics of consumer credit. She is passionate about climate adaptation and just transition finance, and she brings tremendous expertise on how climate change interacts with the finance and society nexus. So I'm so happy for her to have authored this report, and thank you, Cecilia, and welcome.
Thank you, Eva, and good morning, everyone. Thank you for joining us today. We know it's a demanding time of the year when we're all juggling deadlines and holiday planning, so we appreciate you taking the time today. And to start, we do want to draw attention to our reports. As you can see here, they are available online, and if you want some light holiday reading, there are 4 reports. There are 3 country reports, which cover Kenya, Malawi, and South Africa, and a cover note, which is kind of a roadmap of what you can expect in the more detailed country reports, and they can be downloaded from both the ACF and Crutham's website, and the QR code you see on the screen will take you to the ACF's page to download the reports. So while the country note is very valuable, we do want to recommend definitely looking at the country reports, as they go into a lot of detail, and while we will cover some of it today, most of it is there's a lot of extra detail in the report. It's very difficult to condense 150 pages to 15 minutes, and in particular the country-specific recommendations. When we set out and started this report, we didn't want to, as far as possible, give generic recommendations. So we aimed to provide some of a blueprint for the kind of action that's required on the one hand, the stakeholders required, and people who need to meet at the same room at the same time to and what needs to happen for certain recommendations to take place. For example, to get the insurance industry more involved, insurance focused recommendations as well. So we hope you enjoy that. Moving on to, I'm just going to give a brief overview of the research context and the kind of objectives of the research. So, so the countries we looked at have all been hit by extreme weather events in recent years, and every time that happens, there's a kind of a level of surprise, which is understandable, which are often followed by strategies and plans to reduce resilience, but it's very often not enough. And unfortunately, the adaptations are seen as the ugly and poor sibling of mitigation. There's not always a great business case for the private sector to get involved in adaptation. Measurement frameworks aren't available or ready yet, or it is quite difficult to measure the impact of adaptation projects, both financially and socially. So adaptation has kind of been relegated to the public sector. It's a public sector problem that should be funded through grant funding. But it is interesting that since the early 2000s, there have been a push for the insurance sector to get more involved, because there's a clearer business case for the insurance sector here. On one hand, extreme weather events drive up claims, which complicates liabilities management. And then on the other hand, there's obviously an incentive to make sure that your assets remain insurable. And it is in this context and with this background that we wanted to see what the situation looks like on the African continent, and specifically the three countries, Malawi, South Africa, and Kenya. And there are typically three ways or three pathways that link insurance and resilience. On the one hand, it offers financial protection, which has been linked to faster recovery after a disaster. On the other, secondly, it could incentivize risk reduction. So designing insurance products and underwriting risk involves a lot of risk assessment, and the price signal can theoretically be linked to incentivize risk reduction. And then thirdly, which is also related to the previous point, the insurance sector can be a partner, and it's almost considered a natural partner in adaptation due to the data access it has, and the kind of risk assessment capabilities. So how we did this research, I'm just going to share something about the methodology. So we relied on desktop research, kind company data, annual reports of companies and central banks and other insurance regulators. Then, very importantly, was the stakeholder engagement. We did, I think it's definitely over 30 stakeholder engagements, but I think it's around 33 or 34, with various groups that are involved in this ecosystem. So insurers and reinsurers, of course, but also organizations like the World Food Programme, UNDRR, and World Bank, which have all been involved in the implementation of insurance and disaster resilience programs at some level, and regulators as well. And then, while this isn't always listed as a methodological step, we sent the reports out for an external peer review, which proved to be super valuable. These reviewers were from the insurance industry, but also research institutions that have published similar reports or have done research along this line. So to move over to the findings, so the first section and the first port of call was looking at what has climate change looked like in each of these countries and what is the impact been on the insurance sector. So I don't want to dwell on this. I'm sure we're all familiar with the rise in extreme weather events, but this has looked different in each country as well. So in Malawi and Kenya, we saw a surge in extreme catastrophic events, and I think since 2019 there were 12 events like that in Malawi and Kenya. And Malawi specifically has been hit by 5 cyclones, which has kind of put the country in a perpetual state of having to respond to a disaster and a big recovery gap. And in South Africa, we've seen an increase in sort of what the insurance industry, although I think there might be other people who also refer to it like this, refer to as secondary perils, which they are events that are more frequent, but the impacts are quite localized. And so, for example, there have been 31 natural disasters recorded in the ENDAT database. And the future, we also explored what the future impacts of climate change could be. And in Malawi, just as a note, the models in these projections are very uncertain, and it looks like, although I'm not an expert, looks like it's actually quite difficult to project the future precipitation levels and so on. But generally, in Malawi, there's a quite certainty that there will be an increase in rainfall events. In Kenya, while a lot of reports talk about an increase in drought and prolonged drought, others say that some regions might actually experience increase in rainfall that could be beneficial for agriculture. South Africa's mixture of all of that, prolonged droughts, also more precipitation, extreme precipitation events, and extreme temperatures. But the important thing here is what it also means for the insurance sector. And currently, this tends to be explored or looked at as physical or transition risks. So physical risks are the tangible impacts of climate change. For example, excuse me, for example, in a hurricane, the buildings that get damaged would drive up claims, it would just disrupt businesses, and eventually, which is something that we have seen, in all three of the countries drives up the premiums. Transition risks come from the changes that are required to move towards a low carbon economy. So changes in policies, technologies, and market preferences. So a good example here is South Africa's very high exposure to transition risks due to the country's reliance on coal, and also insurers' exposure, insurers as institutional investors' exposure to the coal sector. And the biggest physical risk in comparison of all three countries was found in Malawi, which is which can be explained, of course, with the 5 cyclones since 2019, but also the limited capacity for the insurance sector to deal and manage the risks. There's a small premium base, and claims from a big event like cyclone could be higher than what your premium income could be. Then we looked at, we wanted to know how resilience is currently financed and approached in each of the countries. And again, there's a lot more detail in the country reports that go into subnational government funding strategies, challenges, and so on. But across the board, in terms of adaptation expenditure, which includes disaster risk reduction, there's a limited budget across all three countries. In other words, all three countries face a massive adaptation funding gap. And this is the difference between what's the funding available and what is required. And it doesn't necessarily only refer to government budgets, but includes also the extent to which the private sector finances adaptation, as well as international climate funds. But more funding won't necessarily solve everything. Funding is an issue, but we also found that there's and this is probably not a surprise, but of course there's an implementation gap, and the biggest gaps emerge between national level policies and how they are articulated at the subnational level, with subnational governments, municipal governments or county governments either not having enough funding or not having the capacity to implement a lot of the projects that are required for resilience. Local governments are at the forefront of implementing these projects. So it looks like that gap is a prominent one across all policies and also adaptation. Then, as I think I've touched on it before, there is also a quite reactive approach to disasters, planning and managing climate-related disasters. And it's evident in the extent to which the government resorts to budgetary mechanisms to fund a disaster response. And while most governments do this, in the country case studies that we looked at in all three countries, this sort of creates the inadequate planning for when a disaster occurs and how response and recovery is going to look like, means that there's almost always a missed opportunity to use a disaster to build back better. So to incorporate resilient measures in the reconstruction phase after a disaster. And this is especially evident and pertinent in Malawi, which is quite reliable, which relies quite a lot on external aid for the disaster response, but foreign or external donors don't always want to fund the recovery phase. They are more involved in the humanitarian phase, humanitarian relief phase. And then finally, the risk transfer focus looks at how is insurance integrated in this mix at all levels, at the household level, subnational government, and then, of course, the national government or sovereign insurance level. And both Malawi and Kenya uses or have used insurance, sovereign insurance from the African risk capacity to scale up social protection for when a disaster strikes. And in general, and in theory, the cost benefit of these policies are quite significant. So the most recent cost benefit analysis shows that for every dollar invested in an ARC insurance policy, the cost benefit analysis wasn't done by ARC, which I think is what there's a $1.9 in return, but it's very contingent on the speed of payouts. So, for example, the $1 can be reduced to 40 cents if there's delays in the payouts. Yeah, there's obviously more, much more interesting information in the reports, but that was quite interesting to find. Then we're moving on to the findings from the actual insurance industries in these different markets, and there's definitely not time to delve deep into this, but I do think it's two important differences emerged. So on the one hand, we have South Africa, which has a very large insurance market with high insurance penetration and density rates. And what it basically means is that a significant, or that more people make use of insurance, and insurance has a bigger contribution to GDP. In comparison, Malawi and Kenya have quite low insurance penetration and density rates, but the industries and the insurance companies in these markets have experience in underwriting climate risks through either donor-initiated programs like the World Food Program's route or for resilience. What these programs typically look like is there will be an insurer who underwrites, and then there will be someone, there will be subsidies for premiums to make the premiums more affordable. And these programs have targeted both very vulnerable subsistence farmers as well as your more market-oriented small farmers as well. So that was an interesting comparison. South Africa doesn't, as far as I know, but I'm quite sure that there isn't any subsidies for premiums in the agriculture sector or otherwise. So, and the impact of the programs in Malawi and Kenya have been varied, but one important similarity in all three markets is that non-life or general insurance products are generally unaffordable for low-income households, smaller businesses, which are typically the most vulnerable amid climate change and as the climate changes. And there are various challenges that occur. So I've grouped them here into three: affordability, infrastructural challenges, and implementation. The affordability relates to the fact that for a large proportion of the population, due to unemployment or underemployment, income poverty, and so on, insurance is just unaffordable. This is going to have been complicated by the growing risks of both and the fact that it has affected premiums and increased premiums. And the third one, which is an important point and something that maybe we can discuss in the Q&A if the opportunity pops up. So it's difficult, the donor funding or even government funding for subsidized premiums are almost never sustainable. And it's very difficult then to keep the program running if the farmers in the short period that the pilot took place can't necessarily carry or pay the entire premium or even part of the premium themselves, which talks to the importance of a phased subsidy approach. But I'm not going to focus on that. Hopefully we can do that later. The other one is, as I'm sure if you've ever been in an infrastructure conference, insurance conference or adaptation discussion, there's massive challenges in accessing historical loss data on the local level, but I think this is the problem across the globe. And then in terms of implementation, a big issue that emerged was trust issues, and there's definitely a need to work more with intermediaries that people are more likely to trust, like cooperatives. We also identified some interesting and innovative implementation models. For example, there's an emergence of and proliferation of digital solutions in this space. And one interesting one was picture-based insurance, which has proven quite successful in, or as a solution to basis risk. And for those of you who are listening that aren't familiar with that, it's the risk that the payout from an insurance policy, it doesn't cover the actual losses. And it is quite a big problem in index insurance, which I think we might discuss later. But the picture-based insurance have actually proven to increase the uptake in underserved areas by using photographic evidence to simplify claims, and it has also increased adoption rates among women, which is an important point. Then bundling insurance, so integrating insurance with products or services in the agricultural value chain, and then lastly, integrating insurance with early warning systems. There's one example from South Africa between Lumkoni and Holland, where a device, a fire detector, which is triggered by temperature instead of smoke, sends out an SMS, and it has reduced insurance losses not only for the policyholders but also in neighbouring regions. This isn't easy solutions necessarily, but it's approaches that could be explored. And then almost done. So the insurance industry engagement, which looks at how and to what extent the insurance industry currently finances or engage in various ways in adaptation measures. So we just I referred to it earlier. There's obviously a much more of a business case for the insurance sector to be involved in adaptation. So we want to see to what extent they are. And there are definitely an increase in investments in specifically agriculture and to a lesser extent water. But the engagement has been confined to CSI efforts or ESG initiatives that provide disaster relief to a community that's been impacted by floods. But one interesting example was of how the insurance industry gets involved. And I think it's interesting because the current thinking around this is kind of being, the insurance sector should just finance everything and take them up. But Santam in South Africa, they have a P4R, I can't remember what it stands for at this moment. But what it does is it sometimes works with municipalities, and it involves sharing information on flood risks in municipalities where communities are close to river, to inform policy making such as urban development and informal human settlement planning. The barriers, there are plenty. The biggest barrier does seem to be the lack of a coherent strategy from a national level, but also the difficulty in quantifying impact. And what was interesting also that, which even though it's not a barrier, but it's almost a disincentive, is the lack of adaptation and resilience integration in the IFRS S1 and S2 sustainability reporting. There's some requirements for climate disclosures, but they could perhaps do more there. Okay, and then the recommendations. So in the short term, it looks like, and it emerged to us that it's not necessarily always to reinvent the wheel. There are programs that have shown success, and success here means in terms of strengthening resilience, not only for a small community, but on a broader level. There's also, and I hope when you guys review the country reports, that sometimes you kind of get the sense that if the right people gets pulled into the right room together, that some of these issues, that it could go a long way in maybe implementing or getting a move on some of the recommendations. And to this extent, country platforms, ECC, South Africa's Presidential Climate Commission, and then to also plug in the ACF's platforms, which is currently in Malawi, the Adaptation, Resilience and Investment Platform, is doing to an extent this type of work. And then mainstreaming adaptation and resilience, you would think that it is already a requirement in project planning and budget planning on a subnational, but it's very often not. And in the medium term, there's some regulatory measures for digitization, like allowing e-signature and remote onboarding, index insurance regulations, and then also a strategic collaboration between the insurance industry. So as I've mentioned, there's been a push for the insurance industry to get involved in adaptation. And very often there's the thinking that the industry should take on all the risks and fund everything and hope everything turns out okay. But what's required instead is, apologies, what's instead required is a strategic collaboration between the public sector and the private sector. The insurance can't be involved in street projects here and there, while the public sector. So you need a more cohesive strategy across the board for more system-wide adaptation and resilience. Thank you. I'll put up the presentation now. Thank you. We can over to you, Eva. I'll reshare the now.
Thank you so much, Cecilia. Thank you very much for this very informative summary, and I appreciate the challenge that you have in summarizing this extremely thorough and helpful and informative reports. And for everybody who is specifically focusing on any of the markets we've investigated, I strongly recommend looking into the case studies, the country case studies, because a lot of the benefits and the valuable insights are in that detail. But thank you very much, Cecilia. We are now moving to the more conversational part of this launch, and yes, we will plan to increase to share the slides and the recording. I see there are some comments and questions that we'll shortly turn into, but let me also introduce Dr. Paul Matitibane, who is the Executive Manager of Operations at the Land Bank Insurance Company. And we invited him to help us unpack some of the findings because of his fantastic background and expertise in this field. He holds a doctorate in business administration, postgraduate in risk management and in public governance, and a bachelor degree in accounting. He brings a wealth of professional experience and a keen interest in agricultural insurance solutions, specifically for small-scale farmers, which, as Cecilia highlighted, is so important. He has been instrumental in the development of land bank insurance companies' alternative crop insurance, which offers to improve resilience for smallholder producers. For example, he piloted the use of index insurance. So I'm really pleased to have him on board, and welcome.
Thank you very much, Eva.
Maybe
and
just
good morning, everyone.
Thank you. Maybe just to kick off the discussion, one question I'm keen to ask you, as Cecilia was presenting the recommendations, and there is a lot more practical implementation advice in the report as well. What did you find as the most useful takeaways from the analysis in the report, especially from the perspective of the insurance industry? And what do you think helpful next steps would be?
Right, thank you very much. And I thought that the report was very detailed. I thought that it was very incisive and quite reflective of the challenges that the different environments are facing, particularly when it comes to climate change and agricultural risk. So overall, I'd like to congratulate the team for an extremely comprehensive report. When one goes through these type of reports, often the recommendations tend to be quite difficult to implement in practice. And the biggest takeaway for me as I was going through the recommendations, and one of them was how insurance can be integrated within a broader framework with government. And that is a standalone solution. Insurance can't be the silver bullet, so it can't be the magic answer to all climate-related matters. And the practical recommendation was looking at one of the government programs, which is the Comprehensive Agricultural Support Program run by the Department of Agriculture, and looking at establishing a national framework within those kind of structures. So I thought that that was an extremely practical example. And interestingly enough, something that we've already started as a business. So we are a state-owned company and have quite close proximity to the National Department of Agriculture. And conversations have started in that regard to say, how do we open up insurance solutions and make them accessible to smallholder farmers, especially in the context that Insurance penetration is quite high in the South African environment, at least if you are to compare it to Kenya and Malawi. But if you were to unpack the statistics, the 10% penetration, and take it to the agricultural sector, the latest available data shows us that there's less than 1% penetration of smallholder farmers into the insurance market. So it's very clear that there's a risk protection gap that exists, and insurance companies alone and in isolation cannot really solve these problems. The second recommendation, which I found quite practical and something that is in implementation by the insurance sector as a whole, is through private-public partnership initiatives. And the South African Insurance Association has been quite instrumental in bringing together insurers to try and find solutions to this particular problem. You would note that the report says there's 162 different insurers in the country, which I thought was quite quite a statistic. But within those 162, there's only less than five that are playing in the agricultural insurance space. So it says that there's still a lot of scope for industry participation. So to summarize, the biggest takeaways for me were the actual recommendations, which I found to be exceptionally practical as a practitioner that's operating within the space.
Thank you. I'm very pleased to hear that. And maybe to just unpack a little bit some of what you said, especially as you highlighted the agricultural risks which are growing across Southern Africa due to climate change and the low penetration in that space, even in such a developed insurance market as in South Africa. And that challenge is exacerbated in less developed insurance markets. So perhaps from your opinion, how viable is it for the insurers to perhaps aggregate risk through regional agricultural insurance pools to help improve coverage in this area?
Yep, no, absolutely. And I think that's quite a useful tool. And maybe before going regional, I think even locally, South African-based insurers, there's definitely a scope to sort of risk pool, maybe even on a co-insurance basis. Because the nature of the risk is that it is so significant that it will be overwhelming for one insurance company's balance sheet, given the fact that maybe from a more technical perspective, but as you write a lot more risk and as you insure a lot more perils, it does put a lot of strain on your balance sheet and particularly the solvency requirements from a regulatory point of view. So scope exists to service the market appropriately by seeing what type of mechanisms for risk sharing can be explored locally. And from a regional perspective, it becomes the idea is a noble idea, but it becomes quite challenging given the fact that the risks are so correlated across the different regions. For example, if there is an El Nino season, which is predominantly dry conditions, that would affect South Africa and the neighboring countries within the Southern Africa tip. So it would spread through to Zambia, even Malawi. So it means that when you have a loss, you have a more significant loss because the risks are not necessarily localized. So they're not idiosyncratic risks, but they are covariate risks. They're systematic risks and they affect a lot of people at the same time. So within a regional pool, one would sort of have to look at what are the regions that are decorrelated, if I can put it that, because that element of cross subsidization by risk will likely yield more positive results. But certainly within a local sphere, I think there's an opportunity for a collaboration just to strengthen insurance access, especially amongst those that need it the most, which would be your smallholder farmers that are sort of disproportionately exposed to weather-related risk due to not having mechanisms to cope.
Thank you. Yes, these transboundary risks that climate change poses, the way it does not respect national boundaries and can be very extraterritorial, is a challenge. I guess for the continent, there is perhaps in this diversification an opportunity in that it is such a big continent in terms of size. But I fully get your point. The other thing, perhaps just to unpack, and please for those on the line, you're welcome to raise your hand. You're welcome to post more questions in the chat. I wanted to ask just one follow-up on the point you raised about public-private partnerships, PPPs, which is something that in the climate finance space has been gaining a lot of. It has been in the insurance space. There have been a number of relevant initiatives. You can see Jonathan Israel from FSD Africa posted in the chat about the Nairobi Declaration on Sustainable Insurance, and there it provides more information on it. Another example is the Africa Climate Risk Insurance Facility for adaptation. And there are, of course, other examples at perhaps a smaller scale too. But from your perspective, what specific PPPs do you believe are most crucial for scaling up climate insurance coverage in Africa? And especially when we also consider how can we better protect vulnerable communities against floods and droughts and cyclones?
Yeah, I think for the South African environment, it's early days for PPP, and these structures are fundamental and they're critical. And I think the voice is getting louder because the evidence of climate change is speaking for itself. So it's very clear for policymakers and for practitioners that we need to undertake a different trajectory and we need a different model for risk management. So certainly if one were to envisage how such structures would work within at least the South African context, is that from a supply point of view, I think the government has quite a critical role to play because government is a trusted agent. And from the fiscus point of view, I think there's a lot that can be done in terms of unlocking subsidies and unlocking certain incentives to stimulate insurance uptake. But there's certainly a big role to play from a private sector perspective because that's where most of the intellectual capital would come in terms of product design, in terms of underwriting, and in terms of pricing for these various risks that we're seeing. The private sector has an opportunity because it's been traditionally underwriting lots of classes of insurance business, as well as access to the reinsurance market, which brings about global expertise. So if you take the technical component and you marry it with the influence of government, it will certainly go a long way in breaching the gap when it comes to affordable and accessible insurance, because again, government can leverage various distribution channels. One of the recommendations on the report was the social program that exists in South Africa, and looking at that program, how can it be used to disseminate insurance, for example, because infrastructure exists even in the most rural areas. So those kind of initiatives can definitely go a long way. I think that everything is still at its infancy stage, but when it picks up, I think momentum will pick up exceptionally quickly, given the risk that we're facing at the moment.
Thank you. Thank you so much. I'm going to just turn to my colleague, Wale Hammond, as he has been looking at the chat and maybe can advise what is the next question from the audience. And that's maybe for Cecilia as the author of the reports as well.
Thanks, Eva. Yes, the first question is for Cecilia. There's a question from Bitiat about, from your research on the 3 countries where the insurance product developed in country.
So apologies, my screen froze. I'm just going to open it on the other. Could you repeat that, Wale?
Yes, Bitiat wants to know if the insurance product you had referenced in the report were developed in country.
They're not always. So very often they're not developed, and it was a point made by she's online, Berber Kramer. That very often the products aren't necessarily led by the insurance companies in country, but they're often developed by research institutions like ACRE or and Pula, technical advisor and broker, and that's especially the case in Malawi and Kenya. Like I said, they hasn't been a similar program or product in South Africa, as well as program, if you consider all the stakeholders involved in the funding. But it tends to be developed and pioneered by the technical advisors and research institutions. But what does happen is that, you know, as I mentioned, the insurance industry underwrites the policies, and they do build up like experience and capacity to then offer the products at a commercial level as well.
Thank you, Cecilia.
Thank you so much. All right, I think there's another question from Matthew, but before we go to that, I think Mavis is interested in asking a question about Malawi. Mavis?
Yes, thank you. Thank you very much. Yeah, Wole, thank you so much for the amazing work and the presentation. My name is Mavis, and I work with the Global Shield Secretariat. So we work with least developed countries to put in place some sort of pre-arranged financing for disaster risk. So this is really relevant to the work, and we have started an in-country process in Malawi where we are working with the government of Malawi to take stock of what is already available and to understand what the protection gaps are and to develop some solutions for the country. So my question, just like quickly, are you able to highlight what the main gaps were as per the research? So would you say it is like regulatory gaps, or is it mostly at the solution, the financial protection solution side? What we have learned also over time with experience from other countries is that usually the regulatory framework or landscape is not favorable to scale financial protection solutions. So would you say, is this a similar issue in Malawi? And basically, if you can really highlight what the biggest gap you saw with, that would be really useful. Thank you very much.
So I can answer from the experience and the research we did for the report. And I think maybe Iva could share her experience with the country platform. So the biggest gap, I think in Malawi, it's very difficult to pinpoint one problem and one barrier and gap. It's definitely a combination of regulatory factors. For example, even though the Reserve Bank has been quite flexible with certain programs and products, something like index insurance isn't defined yet, but that's not really the biggest issue. I think it's really the exposure of the country as a whole to cyclones and the actual risk of loss for the insurance market. Secondly, is a big problem in affordability. You know, the income poverty, if you just focus on that, is quite high. And I think it's based on the last survey data. It's only people with access to a lot of assets, people who live comfortably, that do own insurance. And some feedback we got is, and I know this is a tried, you've probably heard it a lot, but there isn't always a big demand for the programs, and that could be due to a lot of reasons, a lack of trust, but also not necessarily seeing the benefits of insurance for household operations or farmers' operations. I think those are definitely the biggest gaps: affordability and demand.
maybe just to add to what Cecilia is saying, also in terms of our work in Malawi, which is more focused on the adaptation response by the government. But there are certain challenges, such as in the agriculture sector, where there is an over-reliance on maize, and climate change is affecting the yields of that crop, and therefore need for diversification. It's a good example of how insurance can be a method for supporting not only the management of very extreme climate risk events, but also the adaptation measures that a country may need to take to move towards a more resilient economy. And there are some examples of as the report explores, such as with One Acre Fund's work that try to integrate insurance and adaptation. But perhaps a gap there is looking at the more national level strategic response and helping the government really define its priorities in that space, and helping better coordination with the insurance sector, so that this can be done in a way that not only addresses food security, but actually creates perhaps certain value chains. So yeah, this kind of speaks a little bit to the question Matthew posed as well. I see there are two questions in the chat and one hand. We are going to go a little bit over the hour for those who can stay, but maybe just to kind of take them by order. Cecilia, I think one is from Helen Wolbe around the role of the financial regulators mandate, and how they can have, what role they can play in developing an enabling environment for inclusive insurance access to lower income groups. Do you have any thoughts on that?
Okay. Yes, it's something that's not really focused on, but it's definitely a very important point, and definitely from the research that we've done, where further research needs to focus on. So it is difficult to explain, but it looks like current regulations don't necessarily, and I'm not using the correct terms here, but don't necessarily allow insurers to exposure in terms of their asset portfolio to infrastructure projects or projects that could be classified as adaptation projects. So there's definitely discussions there that I'm not too sure how this could be addressed and the process required to change this. But it is a kind of, it does undermine potential investment, at least on the asset management side from insurers in adaptation.
Thank you, Cecilia. And I do like that this question was raised. As a former regulator myself, as we discussed how the insurance sector can play a bigger role, we also must think about the viability of the sector and the financial stability aspects, and some of that is also thinking through regulatory frameworks or things like climate scenario analysis exercises and so on, to help the sector itself understand better the exposures that it's having, that climate change is creating, and that is something that the reports also elaborate on, so that it can take up a bigger role. Wale, can I just check if you're still on, because I see there is a hand. Maybe, sorry, I'm not sure whose question was next, but maybe I'll give the floor to Bran Atiku.
Yeah, thank you very much. I think this was a very nice presentation, and for me, I just wanted to have a quick one. I think the recommendations are very fantastic for the work which is across the countries. But I just wanted to know, because in most cases we have these studies, they are conducted with very fantastic recommendations. But at the end of the day, sometimes even after the studies, the people who are supposed to benefit from these recommendations also even cannot know where to start. I don't know if there's any possibility of seeing how these recommendations can be linked to best practices, so that it can be like a starting point for countries which are like have not done that before and have not started before. I don't know whether that possibility is there, because I like the examples that were brought out also, I know, but that's what I wanted to understand about. Thank you.
It's very difficult to answer that. We try to keep the recommendations quite context specific, but to an extent applicable or scalable, at least in a different country. And of course, 8 months to do the research. The next phase, I'm sure that not all the recommendations can be implemented immediately in every context, but they are, we do try to identify some like low-hanging fruit could be taken further, but it would be very difficult to say that, to give a solution for a universal problem that can be addressed with one of our recommendations. And there's definitely, that's where I think definitely maybe the country platforms could be a kind of like a starting block, or to at the very least bring the right people in the same room. Very often it's just actions or some strategizing. Very often there's projects being implemented or efforts being made on one end without knowing that similar stuff is happening at a different place. So I don't think I could give you a satisfiable answer to your question. I definitely think it's locally, they should be locally relevant, but they could be scaled. But it's not up to us.
Thank you. Thank you, Cecilia. We are getting very good questions, and the complexity of the topic is precisely why we are so keen to use those reports as a basis for more engagement and to unpack some of those more difficult questions. I see there are a few other ones from the chat that I just am keen to pick up for those who are able to stay. I see a question from Raj, perhaps on the back of the discussion, also with Datompo, on the risk pooling and the challenges for domestic capacities in the insurance sector. So the question asks, would risk pooling with a participation from subnational, national governments, domestic and capital markets be a feasible option? And if so, what would be the ways to operationalize such risk pool? I mean, can I turn to you, Cecilia, on this topic, but also Paul, if you have anything to add from your perspective, would be valuable.
With risk pooling from national. Yes, so we did look at municipal risk pools, for example, and while there is scope to do this, there are difficulties. Sorry, I'm just looking. Are you looking maybe specific as it like agriculture? Yes. So it kind of to link what Dr. Paul said earlier, is the problem that emerges sometimes with the risk pools, and especially, let's say, municipal risk pools, is that on the one hand, you'll have certain municipalities being definitely more exposed to the natural hazards, than others. So what's emerged from a pilot that conducted in the Western Cape in 2019 was that some municipalities didn't want to subsidize other higher risk municipalities who are also not great at asset management and reducing, for example, flood risks through stormwater drainage management. So that is definitely the barrier there, but the opportunity is, and specifically if you're talking about municipal at-risk pools, for example, it could incentivize broader planning and proactive planning instead of having a reactive approach to climate risk management. I don't know if I completely answered your question. I hope I did. I don't know, maybe Dr. Matbane, if you want to add.
Yes, I wanted to add from an agricultural point of view, and it's a great question that Raj asks. And it's a powerful statement that domestic insurance capacity can only go so far. And I guess a very classic point of effective risk pooling would be that of the Africa risk capacity, which effectively provides drought cover for member states of the African Union. And we've seen that work quite well using index insurance, particularly a satellite-based index insurance, as a measure for responding to extreme drought in the different countries. And because the risk pool is sufficiently diversified and there's scale into it, it creates a model that is viable. And we hope to see similar type models starting to take place, at least from a municipal point of view, in order to risk pool within different countries. But a really good blueprint will be the work that Africa Risk Capacity is doing.
Thank you. Thank you so much for that. We are nearing the end. I just want to pick up one last question that I see from Violet, because it is a very important point around the margins that smallholders need to work with and affordability. And perhaps that links also to one topic that the reports do comment on, which is the use of subsidized premiums. Again, maybe I will return back to Paul for your thoughts on that topic, given your practical experience from the market, and Cecilia, maybe you can conclude.
Thank you, Eva. And it's the business case is very simple, and the evidence does point to the fact that smallholder farmers tend to be quite constrained when it comes to available capital. Therefore, paying insurance is a big challenge, and we see with the low insurance penetration, particularly across the African continent, and evidence suggests that there hasn't been a successful, at least when it comes to parametric index insurance solutions, there hasn't been a successful product without an element of premium subsidization. So in a way, one can't have a discussion about index insurance targeted at smallholder farmers without including the subsidization component. Within the Kenyan model, I believe that the livestock index insurance program starts with a subsidy scheme of about 80%, and it declines to 70, 60, and so forth year on year. But that's done to stimulate insurance demand. So the subsidy levels really start coming up at a high percentage, and that points to sort of the high insurance penetration that we see in insurance in that country when it comes to agriculture. But within the South African environment, where conversations around premium subsidies are still pretty much at an infancy stage, we then see what is referred to as a dual agricultural economy, where sort of your more well-industrialized commercial farmers are taking up insurance, and there's sufficient risk mitigation at commercial farm level. But we see a disparity in that there's low uptakes of insurance from smallholder farmers, which need it the most. And I think the element of premium subsidization is one of the biggest ones. As a state-owned insurance company, we form part of a broader banking group. So our parent company is the Land Bank, which is an agricultural financier. And within the finance and insurance component, we've introduced blended finance schemes, where there's loan component and grant components that are raised from national government. And embedded within those components is an element of insurance subsidization. And the plan is to accelerate the growth of such schemes to make sure that insurance is supported by credit, but it's also supported by subsidization, because without those elements, there's effectively no insurance market, and you have persistence when it comes to insurance market failure. So that's the view that we're taking, and hopefully all these schemes will start gaining momentum to close the risk protection gap.
Thank you so much for this and for all your contributions to the discussion today. We are very grateful. Cecilia, is there any nuance specifically from the perspective of the Malawi markets that you may want to add to that question?
Malawi is quite difficult because of the small insurance markets, and definitely if you want to strengthen the resilience of smallholder farmers and subsistence farmers there, typically the thinking is you should have a phased subsidy structure, but given the risks that a large portion of that farmers face, and significant amount of subsistence farmers that are there, the current approach with the scalable cash transfer mechanism, which uses index insurance triggers to scale up an existing social protection program, I think is the better approach, where it's completely subsidized. In other markets, like Kenya and South Africa, where your smallholder and little bit more market-oriented smallholder farmers are a little bit larger in terms of quantum, the amount. A phased subsidy approach is often recommended to encourage policyholders to use insurance in the way that Dr. Mpho described, to take out loans as collateral, but effectively to act as a sort of a safeguard to increase yields and increase output of your agricultural, so that towards the end, ideally, and on paper, you wouldn't need premium support. And the reason why this is recommended is because it's very often difficult to sustainably fund the premium subsidies if agricultural risks go up, and in the absence of meaningful adaptation efforts to reduce.
Thank you so much for this, and thanks everybody who has stayed for the entire time. I'm conscious we can't cover all your questions, but we hope to be able to engage further on this topic. I'm just putting in the chat as well my email so you can reach me. And we thank you all very much for this very informative discussion and for your attention joining, and I hope that you find the reports helpful to your work as well. Thank you very much.